For today, we want to exactly focus on one skill, winning the rate conversation. People communicate, focus on non-essential things. I think people are not applying to us because of the rate, because of the fee. We are just failing to deliver the specific information at the right timing. So housekeeping is very short. Putting your face to the camera, to connecting your voice is an optional. It doesn't have to be in that way every single time. However, the communication chat is mandatory. So the game plan here is to learn about the options we have. The playbook that I want you to have is number one, how LLPAs actually build a rate, and first-time homebuyers waivers, 30-second AMI check, and the pricing ladder. Then for the next 35 minutes or so, we're going to run with 17 different client scenarios that I went personally. And then, I'm going to compare. When you deliver the client the information and you type in the place in the chat before you, reveal the rate, term, and fee, sometimes wrong answers are welcome when the time-sensitive matters come. For example, on Saturday night, when an offer needs to get submitted, it is okay. You just close with, outdated rate, term, and fee. People will understand. However, being silent, ignoring text, call, email for the 3, 4, 5 days and extensively for weeks it's not going to defend you. Whatever that you have built will just crush. You have to reprice it, you have to restructure it or reframe it. You have to pour the same amount of work all once again. So objections that we encounter, I want to call this objection as an enemy. And I'm sure you heard at least one this week. One of them will be rates are too high, especially for yesterday and today. Anything that you have quoted last week is just, crushing down. Rates are too high, we'll just wait. Second one would be, my friends got 3% in 2021. Why can't I get one right now? Why can't I assume the seller's rate right now? Third is, the rate online, presented online is lower than yours. Or I'm not giving up my 3% to refi into when we're dealing with cash out refi or selling the second trust deed loans. And 5, there are no program for someone like me because the qualifying income is significantly lesser than actual. So when you are dealing with those clients, none of them are asking you to provide a solution. None of them that is defending the rate that we are going to sell. So we are going to play, instead of saying and replying to that question directly, we're going to reframe the paradigm. We're going to reposition ourselves and saying sorry or but, we're going to continue and say and move on to these topics. So tool number 1 is there is no the rate option that you have, that you build online, is usually built to reduce any friction. But in the fine print, it shows additional fees, additional add-ons on top of the actual pricing. So real pricing starts with the LLPAs, the loan level pricing adjustments. This is a risk-based fees Fannie and Freddie Mac charged on every conventional loan, set by the grid of the credit score, by LTV, and any add-ons for the condominium, any loan amount increment such as high balance of the high-cost counties, 2 to 4 units, and subordinating financing. So look at the real grid. Fannie Mae's matrix, dated 2026 January, a credit score with 705, putting 5% down at a 1.125% LLPA. 780 credit score buyer was the same LTV, only get penalized for 0.25. So rule of thumb is every 1% in fee is roughly a quarter point in rate. So when you look into it, it moves with the market. So when it's close enough to sell, when the buyer calls and asks, what if the rate of 0.125 increment or decrement impact the total fee? That we can immediately calculate 0.5% of the loan or 50 basis point of the loan. So 2 buyers, same day, same lender, same house rules can have 2 different results depending on which product you are sending the buyer to. The moment your client understands the pricing is a personal thing, then the online rate that you and I see will not be an objection anymore. Now people will trust in the descriptions, explanations that we deliver. So first-time home buyer LLPA waiver started back in 2023. Now, when at least one borrower is a first-time home buyer, not all of them has to be one, just like Dream for All products. At least one borrower as a first-time home buyer no residential ownership in the last 3 years, and that lives in 1003 Section 5A, and total qualifying income at or under 100% of area median income or 120% of high cost areas. So for Californians, you have to pick and choose, but for Washington or Georgia files, you don't have to worry about the high cost areas. And three, conventional purchase of principal residence, not for second or investment homes. So if you pass all three, then Fannie Mae waives every LLPA on file, not just the grid, but the condo add-ons, high balance, adjustable rate mortgages, 2 to 4 units, subordinate financing, all of it. All the fine prints can be eliminated in the matter of a couple clicks. But the mortgage insurance still applies over the 80% LTV or above. And the minimum MI coverage option for LLPA is just one fee that can't be waived. So you can use the standard coverage on that part. And there's nothing to code. When DU flags eligible files automatically, then the mortgage insurance and the determining factors will be listed in there. So when you know these number, especially for transactions in Georgia, any annual income under 114,000, then you can immediately qualify and send out the best rate possible. For California files, if you look into these, the area median income is now different. So you have to make sure you understand the reasons why and how much numbers can be different. So if you go into Fannie Mae AMI lookup, then you'll be able to see the updated income information that is updated on June 13th of 2026. So when we wait until June of next year, this income will also increase. So here is the habit that I want you to have, the checkpoints that I want you to memorize. One is to get the property address, not the city. Search the county and the property address. 2 is run it through the AMI lookup tool, Fannie or Freddie Macs. It doesn't take more than 30 seconds. And 3, screen if this buyer is a first-time home buyer or one of the many are first-time home buyers. And you apply the 3-year test. The ways that we calculate and find out is to provide either 3 years of a W-2 showing the mailing address or 3 years of a 1040 if it's a self-employed. And 4, you summarize and add all the qualifying income for everyone on the loan. And 5, watch the DU or LPA with eligible message. And 6, price it both ways and show the client the difference side by side. And by showing them 2 different options at the same time, it will help you and to win business. So when I mean by some qualifying income for everyone on the loan, let's say husband and wife both apply the loan. Because of the LLPA removal, because of the specialties, we may end up removing the husband or the wife. We don't have to apply both when the DTI is at around 30 or 20. When the qualifying income is too high, intentionally pulling out one of the applicant can be necessarily done. So the new standard that we're applying today is to apply is no conventional purchase pre-qualification, leave your desk without an AMI check. This will help you to save another deal. So put it together as a ladder, one thing at a time. Add or under 50% of an AMI and the first time, you can apply to Home Ready. All LLPs are waived, plus there's a Fannie Mae lender credit of $2,500 on all the purchase loans until February of 2027. And add or under 80%, Home Ready or Home Possible can be selected with LLPA waived plus reduced MI coverage. So whether you have a 620 credit score or 800 credit score, this reduced MI coverage applies. Add or under 100% for normal counties and 120 in high cost counties, and the first time home buyers, the standard conventional with all LLPAs waived. And above these limits, you apply the toolkits that we mentioned, ones that we mentioned before. Seller paid buy downs, lender paid buy downs, buy down points with temporary, permanent, with you calculate with points break even points, blended rate, second liens, etc. You gotta now creatively find the solution. Never quote a first-time home buyer until you know which position we're standing on. So when we talk about the scenarios, I want to divide it into multiple factors, four sections. And when you read the setups, and it's okay, I want you to also dive in and answer with me, so that you can learn and take away from the training today. So let's dive in. So first drill. This is the most classic one. Daniel and Grace, first-time home buyer, purchasing a home in Suwannee. It's a townhome, not a condominium. $420,000 sales price with 5% down. Loan amount was $399. FICO was at 705. Qualifying income was $92,000. And Grace says, the rate you quoted is too high. Let me look around. I think I need to apply elsewhere. So the immediate play would be applying for letting the buyers know about the waiver option. And you tell them that wherever you go, wherever this person goes, will receive similar rate. Or you can confidently say that you can provide the best rate to this client because you don't have to worry about any LLPA hits. Both first time, when you are confirmed on the 1003, whether their credit score is 703 or 719 or 780, at around 90 to 95% LLPA, 90 to 95% LTV, fixed LLPA was 1.125. That is waived. So with this specific scenario, now you can sell the same rate and then provide a lender credit of 4,489, or sell something lesser than quoted rate so that we can win. And when you look into these options, about 0.25% rate can be better. Okay. And second, this is a software engineer. He was trying to buy a condominium, $700,000 sales price with 10% down. Loan amount is 630. FICO was at 760. So when income was at $115,000, this borrower was saying this person is making too much money for the first-time home buyer. She was looking up the Home Ready or Home Possible and already disqualifying herself. So I stepped in and I told her that area median income can be defined differently in Orange County. We are looking for 120% of AMI. That now she is qualified and can get the better rate and can receive the first-time homebuyer benefit. And now we were able to, talk about the rate, payment, and term options. So with this case, because of the LLPA, we were able to save 1.25% or 125 basis point on it. So never let a client disqualify themselves because of the income limit. And this income limit for W-2 is gross income. For business owners, we're going to use net income. And the third one, young couple trying to buy a condo in $450,000 home, 3% down with loan amount at $436,500. Credit score is awful at 665. Gross income combined is 88,000. And they were saying because of their credit scores, they were not going to apply because they find out that the conventional rate at this credit score is just awful. So they ran through the Zillow home loan calculator and then they stopped themselves. So I stepped in, told them about the waiver options, and told them the grid chart showing them lower credit score usually get the hit, but as a first-time home buyer, this point and the hit is going to be eliminated. Now, not only they waive the hit, but they're getting the same rate as if they had a 740 score. So the 2 points of LLPA hit is now removed. So the rate was able to go down to 0.5. I was able to tell the realtor that we can save this deal because we were able to give this target payment to the buyer. So this buyer was actually complaining about the rate, about the monthly target payment. As we identify the biggest hurdle, all we had to do is to answer the question and a solution. Family of four, this one, they were renting for many years because of the job loss. And even though they all came back in, they don't feel comfortable of applying the loan again. There was some hurdles they had to go through. So they were saying, because we owned before, I don't think we are first-time home buyers anymore. But we were able to identify this borrower as a first-time home buyer because we ran the 3-year test, and it's not a life sentence test. No ownership interest in the last 3 years, proved by the 1040 copies. And because they were sold property adjacent homes in 2021, 5 years ago, by providing the final settlement statement from the escrow company, they became a first-time home buyer again. So it runs off the 1003 5A section, right? Because it's been more than 2 years, we didn't have to go through that piece. So this first time home buyer definition resets every 3 years. So when did you exactly sell is the question that I want you guys to ask. You'll be very surprised. When I did the first time home buyer last month, one buyer was already disqualifying oneself because all the first time home buyer only down payment assistance programs can be also plugged in. Now, first time home buyer definition is very different to first generation buyer definition. Let's not mix them together. Okay. And this one, married couple in Duluth. He sold his condo back in 2024. Now she never owned. Qualifying income is 105,000 combined. Credit score is 728. Home value was $420,000 with 5% down. They were asking, half of us owned the home. Because he owned the home and she didn't own the home, that kills it. That eliminates the first-time homebuyer benefit, right? And then I answered no to this question. First, when one of the applicant is a first-time homebuyer, that is good enough. Income already had qualified them because the gross income was under the LLP. The income was under the income limit of area median income. So we were able to waive the 0.875 add-ons and was able to deliver the best rate. I think at this time, first-time home buyer definition and delivery comes with explanations and a lot of education. So when one first-time home buyer is on the loan, then we can do it. Let's tweak it a little bit. When both of them are not first-time home buyers, we can intentionally put one first-time home buyer in there and then make it happen. So when a son and a mom applies a loan together, when a sister is a first-time home buyer, we can plug the sister in and then still qualify the loan. Now, this one is very unique. We received a pay stub at the pre-qualification stage and accidentally issued a pre-approval. It was a pharmaceutical sales rep in LA County, first-time home buyer. Base pay on W-2 was $118,000 with a bonus of $20,000. The catch was that this, employment history was only 9 months. So he was saying because his W-2 quoted was $138,000, now he was over the limit. So I asked him to provide additional income documentations with employment letter, and I was able to differentiate the base pay and the bonus income. And because of that, we ran the qualifying income test, and income we actually used for the guideline was to deduct that bonus income because it was under 2 years of history. So compliance framing, when you delicately approach the buyer, educating the buyer carefully, then we don't have to, immediately shut down because of the information that buyer is bringing in. When you pre-assumptively review the W-2 and pay stubs and incorrectly calculate the bonus income or RSU over time, then you may not be able to provide this first-time home buyer rate deduction. It's not us. It's not on us. It's not on the W-2. We just have to ask additional documents up front. When did you start working needs to be also addressed. The documentation rules decide on this part. So when you talk about the waiver, we don't have to receive the 1040s, but employment letter can be necessary. When you do the math, when you do the underwriting guidelines, don't rely on the W-2s and pay stubs only. Cosigner was also a trap. This nurse was making about $78,000. Her debt to income was 44%, and dad was offering to cosign to make the deal stronger. So his income was about $60,000, but his credit score was awful at 690. Home price was at 420, 5% down, and daughter was asking, is adding my dad helping the loan because it reduces the debt to income? So my answer was that it wasn't. It was actually difficult. It was becoming a difficult case because every borrower on the loan brings their income to the AMI test, the area median income test, right? And with the dad, qualifying income was at $138,000 over the line. So the LLPA waiver was eliminated. So I had to educate her to remove the data as well, and then apply her separately. So the back-end story with this scenario was the borrower, the nurse, had to use the father's funds for the down payment, but she didn't know how to structure this gift funds. And surprisingly, the bank who qualified her didn't even know how to address and document this gift letter incident. So I was able to teach her that the primary transactions doesn't require any necessary documents for the gift donor's documents, and we were able to save the deal again. And this is a deal talks about a single mom situation. Her income was very low. It was at annual income at $54,000. So when I did the AMI income tax rule, it was running at 47%. Credit scores at 680. So she was looking for mobile home, and I was educating her the mobile home purchase doesn't have to be done. She can buy something a little bit better. So she was now looking for the condominium sales price at $300,000. She didn't have any down payment that she saved, so down payment was at 3%. And she was telling us that because of her income, owning a home isn't realistic. So if she had told me that upfront, I wouldn't have continued the consultation. But by then, I was talking into this situation for more than 2 weeks. So I brought this home ready product. I sent her some articles talking about this program, and told her that not only does she get the LLPA removed, Fannie Mae is also giving her a $2,500 of credit towards the transaction. So now she's like shopping around, finding out what kind of options that she can take. So in her eyes, that was a yes. She didn't have to worry about all these things. She was able to qualify, and she was able to make the monthly payment that is as same as the monthly rent. So sometimes understanding what they really want to hear comes from the depth of understandings that we have with the loan products we carry. And I'm going to cover this part with the LA teachers. As we all know, teachers are getting paid sometimes 9 times of a year, 10 times a year, right? So we cannot rely on their recent pay stubs or W-2 or written verification. We also need to make sure how many times they receive income. So this person was a first-time home buyer making about $95,000 a year. So it was well under $129,000 income limit. So we pre-qualified her, pre-approved her, and sent out using the income showing of the pay stub. That was a huge mistake because as we started the escrow, they were saying because the income was shy, we had to apply for the down payment assistance program. So we applied, and then problem became bigger, deeper. Down payment assistance program, the second lien with 0% APR, they were saying the assistant income actually calculates income differently. So this is a situation. First trustee loan from Giving Tree was qualified and was conditionally approved. Second trustee with HOP was not approved because of the income limit and how this income limit applies differently with first trustee loan and the second trustee loan. So first trustee loan looks into how many times did we receive so that annual income can be divided into number of total months in a year, 12 months. So qualifying income showing on the pay stub and the 1003 was different. But on the down payment assistance programs, we were able to use that income on the pay stub multiplied by 12. So it was actually significantly higher than the AMI. However, we were able to save this deal again. By applying the LLPA removal, first trustee rate went down significantly. So the total debt to income was actually passing again because we didn't know the second subordinate financing LLPA also can be removed. So when you run the loan sifter, at the bottom of the pricing engine, there is a section where you can put the subordination add-ons. If you accidentally click that on the down payment assistance programs, you'll be able to see the additional 0.625 add-ons kicking in on every single purchase transactions. But with AMI test passes, you can eliminate this fee. So This applies on every single LA County down payment assistance programs that we have, LIPA, MIPA, HOP, and Greenlight. So when you look into these ways, instead of saying no and sorry, understanding the product, pre-qualifying and pre-approving the applicant before getting into the transaction is critical, because not only we can provide the better rate and better payment, we can also give them additional down payment assistance program and stack it over on top. That's the whole point. Giving the benefit to the buyer, leading to have more relationship opportunities with the realtors we're working with.